Hey everyone, Edward here. So let's talk about Affirm, ticker symbol AFRM. This fintech company is trying to disrupt the loan industry. It is founded by one of the greatest PayPal mafia, Max Levchin. For those that don't know, he co-founded PayPal with Peter Thiel. Affirm recently went IPO and their stock popped about 100%, just like all the other unicorns like Airbnb and DoorDash. At the time I'm recording, the stock is trading at about $28 billion market cap at $117 per share. So yeah, let's dive into the stock and see what the hype's all about. As usual, I'll go through the first part of my analysis, which is the company overview, and I'll touch base on the CEO. First, I want to get into the company's mission because we have to understand why the company is doing what they're doing. Affirm's mission is to deliver honest financial products that improve lives. They are a loan financing company that wants to disrupt the credit card business by offering no fees. Affirm provides a buy now, pay later solution for the retail industry. These loans will allow customers to pay for a product in various installments within maybe a few months to a few years. So this is how it works. When a customer puts a product in their shopping cart, they have an option to use Affirm to pay for the product. Afterwards, they'll be able to select the length of their loan. Affirm's installments ranges from about 3 months to 36 months. Their APR or interest rate ranges from about 0% to 30% depending on the product. Next, Affirm will do a soft check on the customer's credit score to ensure that all the payments will be made. After that's done, customer will pay each monthly installment directly to Affirm using their app. The company currently works with more than 3,000 merchants such as StockX, Walmart, Shopify, Peloton, Adidas, and many more. When customers pay, it goes directly to Affirm, so they are taking the risk of managing all these loans. However, what makes them unique is that they don't charge customers for any late fees or any other BS fees. I will get into how they make money in just a second. Now you might be asking, what's the benefits for the merchants? Well, actually, when these e-commerce sites use Affirm, they see about an 85% increase in orders. It aims perfectly for the window shoppers that aren't able to make the full payment for the product. Now I want to shift focus to the CEO because the greatest asset in the company is the leader. Max Levchin is the founder, CEO, and operator of Affirm. Fun fact, Max is the one that invented CAPTCHA. Yes, CAPTCHA, that annoying thing that asks you questions and makes sure that you're a human. This method was used to stop hackers on PayPal back in the old days. The story behind this was super amazing and I highly suggest you to check it out. He's the next PayPal mafia to become a billionaire next to Elon Musk and Peter Thiel. At a young age, he learned how to code and that's why he was the CTO of PayPal. After PayPal was sold, he actually started many other businesses such as Slide, and this was sold to Google. All in all, he has a really great track record and he is a CEO that I'm willing to invest in. Now I want to get into the second part of the video, which is the investment strengths. In the fintech sector, they have about less than 1% of the market, which is not a bad thing. This is actually a great thing if they're able to acquire more market share, and this will actually boost our investments. The total addressable market that they're trying to penetrate is about $25 trillion, and this is the global retail market. The company is currently vertically integrated in terms of software. They are a service as a software company. However, they are dealing with loans, which is more risky than the traditional way of exchanging value. They do have first movers advantage in terms of a buy now, pay later solution on the web, but obviously there's a lot of competition and I'll get into that in just a second. In Q4 2020, they announced their first profitable quarter, which is a great sign that this business will be lucrative in the long haul, which is probably another reason why that the stock popped about 100% on the first trading day. Now again to the next part of the video, which is the competition. The obvious competitors are Visa and MasterCard. These two companies are probably the reason why a lot of Americans are in debt, and that's due to their late fees and all the hidden fees that the customers are not aware of. Obviously, the credit card business has an advantage in terms of rewards such as cashback and travel points. This is something that Affirm will need to implement in the future once they fully scale. Personally, I pay my bills on time, and the reason why I use a credit card is because of the cashback rewards. Otherwise, I'd rather pay for the product in full with a debit card or cash. However, I believe that whoever provides the best customer service will win, and the credit card services are definitely behind. There's also Klarna and Afterpay, which are also buy now pay later companies. Klarna is valued at about $11 billion and Afterpay is only worth about $100 million. At the time I'm recording, Affirm is the biggest out of the three. However, it seems like based on growth and the road to profitability, Affirm does have the upper hand. Lastly, the competition includes all the other fintech fintech companies such as SoFi, Square, and all the other players. It's actually a bit difficult to count these as competitors because each one of them are solving different money problems in our world. SoFi is trying to become the internet version of a bank. Square is also doing the same thing with an added bonus of their merchant business. Right now, it's a winner takes most situation in the fintech space. Each of these companies are trying to take the crown from the traditional financial services in their own game. Now we'll get into the next part of the video, which is their business model. Affirm makes money in two ways, which is interest rates and merchant fees. I'll first talk about interest rates. Affirm generates revenue on the loans that they provide to their customer. The difference between Affirm and the credit card business is that they won't screw you over with hidden fees. Max Levchin doesn't think that the way to operate a business is to screw over the customer with all these stupid fees. Furthermore, they have an average APR of 18% with all the loans combined. Affirm stated that the average size of their loan is about $750 and customers would normally pay it back within 9 months. Obviously, Affirm doesn't have as much data as the big credit card businesses, so they do have to offload risk. Affirm raised about $100 million in debt financing from other financial institutions. This cash will actually help Affirm underwrite loans themselves. To minimize risk in the long run, Affirm actually collects 80 data points to feed into their algorithms. This is very similar to what Lemonade does, but for the insurance business. Max Levchin stated that most of the loans that they actually issue are always paid back on time. In some cases, Affirm actually offers a 0% APR on products. While Affirm doesn't make money on these types of loans, they actually make money on the merchant fees, which transitions perfectly to the next way they make money, which is their merchant fees. Affirm charges merchants a percentage fee for every sale that's done through their own platform. On average, the fees are about 2 to 3%. The actual fees depends on the sales volume, purchasing price, and the types of goods sold. Merchants pay Affirm a fee for handling everything with regards to payment process, as well as for taking on the risk of payment default. Now we'll get into the next part of the video, which is the risk to look for. Obviously, intense competition is a big one because all these fintech companies are in a battle royale for market share. To stay competitive, Affirm will need to add more incentives for a customer to choose theirs instead, such as a cashback reward. I understand that this might be something that will be implemented further down the road because they're only focused on growing their company at the moment. Another risk is the current situation with the Rona. Recently, consumer spending has declined in December, and that's a crucial sign. That means customers are spending less money during Christmas, and this is a time when the retail industry really shines. On to my last point, I don't really count this as your risk, but it is an uncertainty, but I'll mention it here. Right now, they've shown that they can scale in the United States, but the largest businesses in the world are able to scale internationally. There are still many questions on whether this type of business will be successful in other parts of the world. If they can get into the Chinese market, then this will be an easy 10 bagger, maybe even 100 bagger. But it will be really difficult with Ant Financial Group in the mix. As for now, this is uncertain, and this is actually something I look forward to when I invest into a company. Now we'll get into the next part of the video, which is the valuation and financials. So if we look into their growth, they grew revenue by 90% from 2019 to 2020, which puts them in the high growth category for stocks. This company is richly valued at a price to sales ratio of a whopping 56. However, young growth companies these days aren't focused on making money, they're actually focused on expanding their business, so this is a food for thought. If we look into their financials, they have a cash position of $684 million and a total debt of $1.1 billion, which is a bit worrisome for an investor. They have more debt than cash, but we do have to keep in mind that they underwrite loans themselves and they take out debt to offload the risk. Next, they have a current ratio of a whopping 16, so they have more assets than liabilities in the next 12 months, which is great. The company currently doesn't generate any free cash flow and they're currently not profitable. All in all, they have decent financials, but in terms of their growth, it is spectacular. Now we'll get into the last part of the video, which is my thoughts on Affirm. As an investor that really likes this business model, it really sucks and it's a bummer that as a retail investor, I'm not able to get it at its initial valuation. All in all, this is a niche market that in the future could take over the credit card business. Affirm is still in its early stages, but if you have a really high conviction for this business model, then it could be an easy 10 bagger, especially with Max Levchin at the helm. They are solving the issue of earning customers' trust when they try to borrow money without screwing them over with hidden fees. I see a lot of similarities with Affirm and Lemonade, but in two different sectors. Furthermore, the net promoter score for these credit card businesses are insanely low compared to Affirm at about 83. This is crucial because customer service is going to be the secret recipe for success in a business model like this. Now remember to do your own research and due diligence before buying any stock. That wraps up for this video. Thank you for watching, and I'll see you guys next time.